All right. Traders, friends, family, fans, followers from around the entire globe. It's your boy, Jeremy Alexander Newsome, with Mr. Austin Lieberman. We are chatting today about his history, his background. This is just the interview process where I meet new people on the internet, total strangers. I reach out to them, and I just ask them their questions about their storied trading background, the stock market, try to get some insights and glean some information. And this man, as you can tell, is a male model. So he wanted to do a video interview. So I was like, let's do it. Austin, what's up, man?
Thanks, Jeremy. I'll be your internet friend any day.
Thanks, bud.
But seriously, thanks a lot for having me on. I really appreciate it. I've checked your stuff out a little bit. I'm a big fan of your energy is the first thing that I would describe you as having. And then just your persistence too. I've seen some of the stuff that you're sharing on LinkedIn about, I watched a video of you talking about if you're selling something, you should be proud enough about it to go door to door and sell it. And like, I think you can apply that to whether you're selling something or like trying to go achieve something. Like you should be proud to tell people about it,
That's a good point, man. Well, thank you for watching those videos. It means a lot it means a lot, man. It really does. And thanks for saying those kind of things. So Austin, man, who are you? Why are you involved in the markets? Give us that cool background, whatever that looks like and however long that might be.
Yeah. So, I would say I'm probably not somebody that when we watch CNBC and other financial entertainment networks, or I think Carl Richard calls them financial pornography networks. Right. I'm not somebody that I think would generally relate to that stuff, or that you'd think would be an investor by watching that stuff. And so that's why I'm thankful for people like you. And that's why I try to get out there and share stuff, is because there's people who like don't fit into that mold of what those types of channels and media outlets, what they try to appeal to. There's people that really matter, and that's like the mass of people, right, that just don't connect with that stuff. And I think that's what you're doing and what social media, like that's how we can find those people. And so I'm one of those people that just kind of like lucked into learning about finance and investing. And so back as a kid, we did not, struggle growing up, but we were a very like middle class family, I would call it. And my parents were amazing parents, incredibly thankful for all the opportunities. They worked themselves just to the bone to like provide. I've got a brother and sister, so to provide for us and then put themselves last. But one thing that they never did was they never saved, they never invested, and we never talked about money. It was always kind of like a taboo topic. So growing up, I really didn't have that influence.
Yep.
And I went to college and I did what's called ROTC, or Air Force Reserve Officer Training Corps. And what that does is you basically do some training throughout college. And then when you graduate, you commission into the Air Force or whatever military branch you're in ROTC for as an officer in the branch.
Gotcha.
And at that point, so the very first investing that I did, and I use air quotes, is so back then, I don't know if this is like 8 years ago. I know I don't look that old. I look great, but back then, back in my day, in 2011, you could, through a company called USAA, you could get a $25,000, it was called a cadet loan. And it's because your junior and senior year, it's pretty clear that you're going to commission, have a pretty reliable job. So they're willing to extend you $25,000, and it was like a 3% interest rate.
Right.
Is to help with like expenses and stuff for your junior and senior year. So I spent some of it on expenses, spent some of it on like a cruise and other stuff that was awesome.
Yeah.
But then I took like $8,000, and I was watching this guy that you may have heard of named Jim Cramer on CNBC, just screaming about different stuff. And I bought like, I think it was AT&T, Annaly, I believe was the name. It was a real estate investment trust. And then like some reverse leveraged like thing that was related to the volatility index that now looking back, it's like guaranteed to go to zero if you invest in it long term. I had no clue what I was doing.
I know exactly what you're talking about. It's in their prospectus. Like, it kind of spells it out like, hey, this is going to go to zero.
Yeah. So that was my, my first foray into investing. It was a really bad experience. I quickly lost like 50% of what I had. Right. And then was kind of just had this bad taste in my mouth in investing. So fast forward a few years, I get done with some Air Force training and get to my first assignment. And you kind of get like a mentor. And I just happened to be sitting next to the guy and the only guy in our squadron really out of like 150 people that was like a super passionate individual investor. And he was telling me about this stock that Netflix that he spent like, I don't know, he put like $5,000 into it and it was worth like $96,000 or something at this point. Yeah. And he got that stock from a company called The Motley Fool. Mm-hmm. And so I kind of had a bad taste in my mouth about The Motley Fool prior to that, just because of some of their marketing and stuff. It seemed kind of scammy. But hearing this guy that I trusted, I was wanting to give it a shot. So I gave it a shot, and now we're talking 2011, 2012 timeframe. And then from that point on, I subscribed to their stock advisor and rule breaker service. And so once you get in there and you start seeing the quality of the stuff they put out, they're very long-term investing oriented. They show their track record and all their results. It's not like they're marketing at all. But I just learned that way. And I got super involved with the Motley Fool and have been a subscriber ever since. And then more recently, really for the last 2.5, 3 years, I've, instead of going the stock advisor rule breaker way, which is basically you kind of invest in one new company a month. And so I had about 85 companies that I was invested in for a few years. And I was doing okay. I was doing about as good as the market. Mm-hmm. But for the last 2.5, 3 years, I've really concentrated my portfolio down. And right now I hold only 10 companies, actually 11, because I just bought invested in a new company today. And I look for specifically founder-led companies that are growing fast, that have high gross margins. So right now it's a lot of like cloud and software subscription type companies. Yeah. But the basis is trying to have a very long-term approach, founder-led companies.
So when you say founder-led, what does that mean? Can you give me some?
Yeah. So companies the person who founded or started the company they're still involved in management or at least on the board. And then they own hopefully a significant amount of shares. And so the idea behind that is just, in my mind, their interests are more aligned with the long-term best interests of a company versus some CEOs who come in and they're going to have some pretty outrageous compensation packages that are maybe tied to some short-term results of the company, but not necessarily long-term results.
Right.
So yeah,
which makes sense. That's interesting that you do that. Do you have any like metrics on insider holdings or insider selling or anything like that? Is that something also you kind of consider at all?
I don't pay attention to it a whole lot because it happens kind of naturally. Like a lot of founders or management or executive teams, like 99% of their life worth is tied up in stock or options of these companies. Mm-hmm. So it's totally natural for them to like sell some of their options or some of their stock along some kind of like at some pre-planned times. But if I do, if I see like what looks like just a ridiculous amount of shares being offloaded by management or a founder or something like that, then it is certainly a red flag. And I think you can find all those. I think it's like Edgar on basically the SEC website, which we can provide in the comments section of your videos.
Sure. No, that makes sense. I like that. I think that's pretty useful. So what else is another one of your cool criteria that you look for?
Yeah. So really I pay attention to most of the time. And so I mess around with options a little bit, but I'm trying to get away from it just because it's just not my preferred style of investing. But what I really pay attention to is things like annual quarter over quarter revenue growth. So, what did the revenue for the fourth quarter of this year look like compared to the revenue of the fourth quarter last year? Is that growing substantially? And I think every one of the companies I own, they're at like 45% or even 50% plus revenue growth year over year. I look for companies that have high gross margins. And so oftentimes those are, and I'm invested almost exclusively right now in software type cloud computing software tech companies, any of those things you want to call them.
Sure.
But high gross margins, because it's in software companies, it's really easy. So if you're thinking about a software company that makes software, there's almost zero cost to selling another version of that software or another software subscription to somebody, versus somebody like an auto manufacturer who's got to go build another car, which costs money, and then sell that to people. So high gross margins. I like to watch expenses. So, in the type of companies I invest in, almost every single one of them is unprofitable, and that's okay as long as I believe the company can become profitable one day. Mm-hmm. So if expenses are growing faster than revenue, or if expenses are growing as a percentage of revenue, then that starts to raise red flags. So I'm looking for sales and marketing and then like total operating expenses to actually be going down as a percentage of total revenue.
Okay. I'm just taking notes, by the way.
Oh yeah, sure. So price to sales ratio, which is basically just if you multiply all the shares of stock and then divide that by revenue, that's how you get the price to sales ratio. I really don't pay too much attention to that. If I feel like it's somewhere, an extreme, then I'll take a little bit note of that. But that's one thing that kind of differentiates, I guess, the way I invest to maybe some common ways that people say you should or shouldn't invest. Is I really don't pay attention to whether a stock is considered overvalued or not. And in fact, I kind of like it when a stock is considered overvalued, because I think it means people are maybe misunderstanding a little bit. And that I got that trait from David Gardner. It's kind of one of his rule breaker investing traits. Mm-hmm. And so once I find company that has what looks like good numbers in those terms, then that's when I start to say, hey, I want to take another look at it. And then, so that's where I kind of narrow it down and start to do some deep dives on companies and try to learn about what they're actually doing, get to know their management a little bit. And you can do that by going to their investor relations website, reading their quarterly earnings reports. I like to listen to companies' quarterly earnings reports as well as read the transcripts.
Yeah.
Because you can hear kind of the tone of their voice as well as, but then go back and read to get all the data and the details. And really it comes down to just looking for companies and management that I can trust, that I believe are innovative and that are going to be much larger in terms of market cap in 5 or 10 years than they are today. And so, yeah, I can, wherever you want to go, if you want to talk about specific companies or anything like that, I'm happy to dive in, go whatever direction.
Yes, perfect. I was getting excited because I was about to dive in. Before we do that, really quick, I just want to share with everyone who's there, because you're watching the recording. I just want to give you Austin's Twitter handle, because this is how I found you, Austin, because you post a lot of good content, man. And he also has a free investing newsletter if you want to check that out. firstname.substack.com. Click on that, and this is his Twitter handle. So if you want to check him out, I don't know if you can see my screen, Austin, but you might be able to.
Yeah, I can.
Oh,
yeah,
okay, perfect.
Appreciate you sharing. Yeah.
Oh, dude, of course, man, of course. And so, my good buddy Matt and also Kristen. So I actually traded with Kristen in New York City back in late June. We had the Benzinga conference together. So,
awesome.
Yeah. So he's a really, really cool guy. But so talk about this. So you kind of post your your portfolios, and you're very transparent. Why the transparency other than the obvious?
Yeah, and that's not an easy decision. Like
it's not
as obvious as it sounds. I guess I do it because it's what I would want from somebody that I was going to consider, I don't know, I don't want to say listening to because I'm not an advisor or anything like that, but just that from something that I'm going to consider taking in, I want to make sure that the person that's sharing it is transparent. And then I guess because there's a lot of people out there that are, that aren't transparent and don't, might make a bunch of claims or whatever and claim that they're awesome, whether it's at investing or fitness or whatever, and they don't actually share results. So I've just kind of made the decision to share good and bad.
Sure.
Been going well lately, but yeah. And I think it's to show, I would still say my wife and I are middle income, maybe upper middle income. And so it's like sharing numbers like that. Like, I think you were just showing the June, what was it? The June review. So up $60,000, like that. I never even imagined having, like when I first started investing, I never even imagined having that much money to invest. And to think about 7 or 8 years later now, like still middle to maybe upper middle income in 1 month, like returning that much money, it never even seemed possible. And so I guess my goal is to just show people like, hey, I'm just like you. I'm not a professional. I have a day job. But look, this is possible, So I think that's why I do it.
Yeah. Which I like, man. Again, I like to represent the same thing where it's like, I'm not by any means the smartest person in pretty much any room. But
gone the same way my whole life.
Yeah, but you don't have to be amazing at math. Like second grade math, you got to do percentages and decimals and add, subtraction. But once you kind of nail that down, you should be okay.
Yeah.
And one of the ones I would like to ask you about, and just a massive runner, because I want you to explain it to me so that I can learn. I have never gotten on the Roku bandwagon, just from a side of other than the chart. So fundamentally, I know very little about Roku, and I know that's one of your holdings. So tell me a little bit about Roku, why you picked that one, and what your thoughts on that one are for the future.
Yeah. So I never was on the Roku bandwagon either. And for the longest time, I was convinced like, this is just a hardware company that makes, I don't even like the Roku. I tried using the Roku service for a little while and I don't even like it. We have Amazon Fire TV sticks at home, and I don't see any reason for Roku, right? And so this is a good reason, like a perfect example. I'm glad you asked about this because as investors, like we have to be, we can't take ourselves too seriously. And like you said, you're not the smartest person in the room. I'm not the smartest person in the room. And so removing my own survey size of one person, my own feelings about this company, and just looking at their phenomenal earnings results. And I think it was like I forget what quarter it was, but it was either 9 months ago now or almost a year ago now, where they just blew it out of the water. And then they've just continued performing well since then. Roku is one where I don't believe I didn't personally believe in the product, but it's one where the numbers and the business performance led me into getting over myself and my own feelings and just investing in the company. And it's about a 3% position for me, I think. So it's a pretty small position if you look at some of the other position sizes in my portfolio.
Right.
And I keep it small because I am having that struggle of getting over what their real competitive advantage is. But while the company's performing well, I'm just going to keep investing in it. And if that performance changes, then I'll be quick to sell it.
Yeah, no, it makes sense. And I mean, just overall, when you're looking at a position to put into your portfolio, how do you decide how much to invest? So you mentioned 3% is invested in Roku. Why 3? How'd you come up with that number?
Yeah, and there's no exact. It was a little higher, and I ended up trimming it a little bit to add to Zoom Communications. It's another new IPO. Ticker is ZM. So Roku was around a 5% position. But the way I kind of think about it is I think in tiers, right? And so if I'm relatively new to a company or I'm less confident in it, I'll keep it as a sub 5% position. And when I say sub 5%, that 5%, I'm saying I will not I'll keep it to investing below 5% of my own portfolio size in that company. And then I kind of just let it run from there. So if the company does really well, then, I certainly wouldn't, if it turned from a 5% position in my portfolio to a 10% position on its own, if it doubled, I certainly wouldn't sell it just because it went higher. That's generally a good thing. But that's kind of how I think about it, is in tiers. So smallest position sizes or companies that I'm maybe newest to or least comfortable with, I'll keep to about 5% of my own money. And then anywhere to, mid-size, or as I get to know a company better, I might invest, add to it and get it up to a 10% position where I've added 10% of my portfolio size to that company.
Right.
And then really a maximum that I'll add is 15%. And then from there, like I said, I just let the companies kind of decide for themselves. So I'm trying to look at that review now. So I think, Roku on there was 3.43%. And then the Trade Desk was at 18%. Twilio was at 16.8%. Alteryx was at 16.5%, and Mongo Database was at 15.19%. So those are my big four, and those are the four companies that I'm most comfortable in, is the Trade Desk, Twilio, Alteryx, and Mongo Database. Yep. I'm trying to look it up now, but just to give you a feel, and all the viewers around the world a feel, I'm going to try to figure out what my cost basis was. So we'll go with the largest position, the Trade Desk. So it's currently an 18.16% position. And so the cost basis for me was actually about half that. So I put about 9% of, in today's terms, about 9% of portfolio value into that company. And I've just let it double in size to about an 18% position.
Ooh, all right. So now I get because I love, first of all, I love investing. Love picking companies like this. And I like the ones that you're going through. Mongo is the one I missed out on big time. We all have misses, right? This was a miss of my career for sure. I was looking at it hardcore around like the 60-ish area, and I don't know why. I just never did anything with it. But when you're in these positions, I guess the two questions I could really easily ask: do you use stops at all, like trailing stops or whatever? Or number two question, do you use options as any kind of leverage or protection, covered calls, protective puts, anything like that?
Yeah, really good questions. I don't use stops at all, ever. So the last thing I want to say real quick on kind of like allocation and position sizing, right? And I guess this kind of ties into what we're talking about now. I've learned, and actually learned this with the Trade Desk this year, that when a position for me gets over 20%, so somewhere between 20 and 25%, I just get uncomfortable. Like it's too large for me to be comfortable. And so going into their last earnings report, the Trade Desk was about a 23 or 24% position in my portfolio. And I just felt myself getting uneasy. So I sold it down to about an 18% position, and then just left it at that. And then it's kind of stay there. It might have even been a little bit lower than that. It might have been 16%. And it's kind of grown a little bit, but then stayed there. And so the plan would be to just keep it unless the anything in the performance changed. I feel like I need to trim or sell the position, or if it gets back up to 20% plus, I'll then trim it down and then look to take that money and add it to something else. So that's kind of how I think about the upper end of my position sizes, is 20 to 25% is the most I'll let something get to.
25%?
Yeah. Yep. Which is, that just gets uncomfortable for me.
I can understand that. Yeah. That's a sizable win though, man.
Yeah. Okay. So don't do any stops or anything like that, just because the nature of investing in these kind of companies is they are volatile. And so, or volatile, or however you're supposed to say that word.
Mm-hmm.
So another thing I shared in that June monthly update is kind of the drawdowns of my portfolio as a whole. And you can click, if you click on that image. Oh,
Image of the link, or does it matter?
Either one. It's
okay.
It's in here too. So right there, down a little bit. So that's comparison to the S&P 500, right? So for the last 30 days, portfolio was up 6% versus S&P at 3%. 1 year was up 70% versus 10. And then since inception, which is November 2014, 236% versus 59 for the S&P 500. But risk right there is, so over the last 30 days, I had a 10% drawdown.
Yeah.
Over the last year, the largest drawdown was 35%, right? So that's crazy. And that was from September to December. And it sounds horrible, but I was still, so going into that, my portfolio was up something like, I don't know, 80 or 85% on the year, maybe even 90% on the year.
Yeah.
And then I ended up in the last few days of December, actually, I think it came back a little bit. So I ended up for the year, 68% in 2018, or 64%, might have been 65. I posted about it somewhere. But the key, and the reason I'm saying this is because in order to invest in the way that I do with a concentrated portfolio, I have to be willing to watch my portfolio just disintegrate. And it happens in these positions. And when I'll consider selling is if I believe it's happening because of a bad earnings report or the business isn't performing well. But if I were to have stops set, I would probably get stopped out of like every single one of these companies at some point.
Yeah.
And it's just kind of the nature of this investing. And look, like I'm never one to tell anybody, hey, you should invest this way. Like I think people should invest in the way that they're comfortable with. Mm-hmm. So it takes, you just have to be comfortable doing it. So that's why I don't do stops. Talking about options. Yes, I have used options in the past and I'm trying to get away from it. Just for me personally, I'm trying to simplify things. And I do also want to keep it as relatable as possible to as many people as possible that may not have a lot of time to be learning options or considering options. And the other thing is, and you know this too, is it can be easy, and it's not guaranteed, but it can be easy to get yourself in trouble using options. But I've done things, something that I did recently, and it worked out pretty well with these volatile companies around earnings reports. Is I forget the exact term. It was either a straddle or a strangle. I think a straddle is where you do it around the same strike price. Yep. You buy a call and a put at the same strike price, and then a strangle, I think, is different strike prices.
Yep.
So I did a few of those, and basically, so I guess we'll go with the strangles. What I tried to do, and I did this with Beyond Meat. I almost just bought puts going into their earnings report because I was like 100% positive that they were going to just get crushed after earnings.
Of course. And
so I bought puts for about 10% lower than, and I don't know how much time you have, but I can pull up the exact, I documented on Twitter. I could pull up the exact tweet about it and share exactly what I did if you're interested, or I could just talk about it. But I basically bought puts that were 10% lower than the share price. And then later I decided I was going to buy calls that were 10% higher than the share price. And after earnings, it ended up going up 30% in a day. And so those ended up, appreciating 100 or 150% in a matter of 24 hours. I did the same thing with Zoom and a few other companies. And really where it all landed was I may have I lost money on some, I made money on others, and I may have came out about equal, or maybe a little ahead on all of those. And I just decided I feel like it's one of those things where if you're going to do it, you got to do it and you got to stick with it. But that's just not, I don't have the time or it's just not my style,
Yeah,
so I
can respect that.
I have tried, as positions I feel get super overvalued or expensive, I have tried a little bit selling some covered calls at about 10 or 20% higher than what the share price is. But every single time it's ended up like coming back to bite me, and I've ended up having to close them and then and try to raise the strike price or something like that. So kind of just chasing it higher. Mm-hmm. And so I just decided that wasn't worth it either for me.
Right. Gotcha. Now, as far as these positions, I mean, what's your thoughts on anything with dividends? Are those too boring and not volatile enough, or do you have any dividends, Walmart's, British Petroleum's in there to just keep things fluctuated safe?
No, so those you had up, that was my entire portfolio, which you had up there. And none of them are dividend paying companies. And it's not that I intentionally avoid them. It just, the type of company that I invest in and the type of growth that I look for, generally those companies aren't mature enough to pay dividends yet. Mm-hmm. And it's also not, so once a company, and we can use Apple kind of as an example, right? So Apple for the longest time didn't pay a dividend, right? And throughout that period of Apple's existence, that was like their innovation phase where they were coming out with things like the iPhone. I don't know if you've ever heard of that or not. And, new products and constantly innovating. They're putting the money that today is used for, to pay dividends. Well, one, they didn't have that money yet. And two, they were focused a lot more on things like research and development. Mm-hmm. And that's similar to the type of companies that I invest in. They're still very small companies, usually sub $20 billion market cap companies, and still pretty new and early and trying to grow. So for them, it would not really be in their best interest to use that money to pay dividends, because they want to reinvest that to grow the company.
Yeah, which is valid. I mean, I get that. What about any underperforming? Something like, where you're going through these stocks and these metrics, do you look for anything that's just really, really beaten up, or do you look for the trend, or is it just purely based on numbers? Like, are you looking at the chart at all?
I look for companies that have a sign that I love is a company, and I know there's like different trend following metrics, and so I guess you could call this kind of like momentum a little bit, but I look in it, who knows what the cause or the correlation is, right? Of like why some of these things work and some don't. But I generally like companies, and it's counterintuitive. I like companies that have beaten the market over the past year, 3 years or whatever. Mm. And again, I kind of get this mindset from David Gardner and his style of investing is what I believe is that those companies, as they outperform, they not only they get a lead in like market share in whatever industry they're in, they start to attract the top talent from around the industry, because it's an exciting place to work. Pay is going to get better as they're doing better and better, so they're going to continue to attract more people and get more and more of a lead. And then clearly, if they have been performing well, and they've been performing well as their revenue is growing and their gross margins are all staying good, and they're innovating and coming out with new products, clearly their product is successful. So yeah, if anything, I take kind of a momentum approach, and I look for companies that have done well, but that have done well for what I believe is like fundamental business reasons. Yeah. I actually, I try to avoid, falling knives is the term, or turnaround stories or stuff like that. And that stuff works. People do really well with companies like that sometimes, but it's just not.
It takes a long time too to make your thesis be right.
Yeah. And sometimes there's a good reason that companies are selling off,
Yeah. Yeah, exactly. I couldn't agree more. Moving a stop up really quick. Sorry about that. Are there any sectors you just will totally avoid? Like, I'm not going to do pharmaceuticals. Like that's one of my things. I don't do pharmaceuticals at all.
Yeah. I generally stay away from pharmaceuticals just because and so I guess the point is like staying away from things that have influences that are just completely outside of the company's control, right?
Agreed.
So like the regulations on pharmaceuticals, that's probably one of your reasons is, everything they have to go through to get things approved. And you never know if a drug is going to be approved or denied or whatever until it actually happens. But yeah, so for the most part, stay away from pharma companies, but also things that are just heavily influenced by, the price of oil or whatever outside influence might be able to directly influence. So chip makers, sometimes they can be heavily influenced by, as we've seen, things like that. And then really it's just trying to stay away from companies that have to manufacture new things and sell new things and build new cars to sell to the next customer, because when they do that, they've got to build plants to build all these things. They've got to hire more and more people so their expenses go up. And then they take on risk by thinking that they're going to build, and NVIDIA even is another company that, their stock crashed pretty heavily last year. So yeah, you can see it on the chart there. They were doing awesome. They had all this demand. Everything was going great with data centers and GPUs, graphics processing units, all this stuff. And then what happened was management didn't realize the influence that crypto was having on their graphics cards and their data center stuff. And so they lost significant demand in their graphics cards. And really, so it's been almost a year now that the company's struggling. So as innovative as a company as they are a maker of things, and they have to produce and sell more things to be successful. And that came back to bite them. Yeah,
that makes sense. And that was a very, very interesting story too on NVIDIA. I mean, it was down like 50% in like 2 weeks. I was like, what is going on? Well, 2 weeks, 2 months, but that was wild.
Yeah. And that's it. So that right there is a good example. I was invested in NVIDIA, I think, when that happened, and I quickly sold. But it was tempting. It was tempting to want to chase that and say, man, this is a great company. I know they're going to come back. And they might someday, but by the time they do and they turn around, like, I believe we could have made a lot more money being invested in the people who are currently winning than the company we're hoping turns it around.
Mm-hmm.
So yeah, it's a perfect example of why I don't chase companies down.
No, makes sense, man. And again, like when you're accumulating or you're trying to pick the bottom or catch the falling knife or whatever, it does take a long time.
Yeah.
And if you do it, what a lot of people have the tendency to do, or at least I noticed, is they'll go, oh, this is it. This is the bottom, 20 grand, boom. And they'll just take most of their powder and add it to that position, that time, rather than getting in like 20 shares every month over the course of a year and do it that way, and accumulate, because that's the term, accumulate. Like when you're accumulating, you buy small bits and pieces along the way, kind of dollar cost average your way. So when it really pops, you're in for a good ride. But yeah, because it's just hard to wait that long. That's the thing.
Yeah.
And when you're in a nice little trends, it's easier to wait.
Yeah.
Yeah, I love it, man. So what's some other companies that you're looking at right now that you haven't invested in, but you're just kind of keeping an eye on? Because you mentioned Zoom. I loved, dude, good call. I mean, we're using that one right now. We know how they make money.
Here, let me try to send you. I'm going to send you a link and see what happens.
See what it does.
Actually, let's see. Can I share my screen?
Yep, you can. Give me a second. I'll stop sharing my screen. And let me make sure. I think you might have to be a co-host or something, but I'll make you co-host.
Is it working?
Okay. All right. Give me like 3 seconds.
I think it's letting me.
It should. All right. There it is. I got it.
Cool.
I'm looking at an Excel sheet or something.
Yeah. So this is WhyCharts. It's a tool that can be used for graphs, and you could do some trend stuff on here. But I talked a little bit about like what I was looking for in companies, right? So I don't know if this is good interview etiquette, and I've kind of sprung this on you, so I appreciate you playing along.
Oh, sure, man.
But these are some of the categories I look for, right? And so this is revenue quarterly, year-over-year growth, total expenses, annual year-over-year growth, gross profit quarterly, sales and marketing expense as a percentage of revenue, price to sales ratio, forward 1 year, total revenue, market cap. And the cool thing that you can do with this tool is you can go in and create basically a scoring model. And so you can go in and I could say gross profit margin is more important to me. I want that to be 20% of the score. Revenue, quarterly growth is also really important. That's 30% of the score. Market cap, okay, I don't like investing in companies that are, I want to invest in smaller companies versus bigger. That's 15%. Total revenue is 10%. Price of sales, I told you I don't care too much about that. That's 5%. And then total expenses, quarterly year-over-year growth is 5%. And then sales and marketing expense as a percentage of annual revenues is 15%. So you do that.
It's kind of easy though. It spells it out for you pretty nicely.
Yeah, you do that, and then it comes. So these are the scores from what I just put in across all these categories. And so Roku, out of all these companies, according to that score list I made, is actually ranked number 1 right now. Twilio's number 2, Mongo Database number 3, and then the Trade Desk number 4. So I just want to share that real quick with you and show you
absolutely
some of the method to the madness a little bit. And then the other thing I do is I kind of just so you can see I used to have so I have 2 options positions still in my portfolio, Nectar and Nutanix, and they're both, you could see on that return thing I shared, they're both worth basically nothing.
Yeah.
But this is kind of what I have. So current portfolio, I watched that and I actually just added Elasticsearch today. So you can add it and it should be in there. And then the data column is so now it's sorted by quarterly year-over-year revenue growth. So Twilio is at 80%, Mongo Database 78%, Elastic 62%, Zscaler 60%, gross profit margin 89, 85. So
what is Twilio selling exactly?
Yeah, they want to be the AWS of communications. And so the way they're doing that right now is basically with APIs, which I don't know all the tech behind it, right? But all I know is that enables different apps to kind of communicate and talk to each other. And they do it all around businesses communicating either like app to app communication or businesses communicating with customers. And so what they're really going after, their big kind of like the big future for Twilio is in the contact center or call center area. So they're trying to really disrupt that. And so previously, think about company call centers, contact centers, they're all in a big room. You got a bunch of people answering phones and all that stuff is managed on premise with servers at the businesses. They're trying to make they are making a fully programmable, customizable contact center that can handle phone calls, emails, texts, all kinds of ways that businesses basically communicate with customers. And they're really starting to take some market share and get some big contact center contracts with companies like Shopify, I think Lyft, and a lot of like companies.
Gotcha.
I think that's they're a $18 billion company now. I could see them, one day as $100, $200 billion company.
Interesting.
Yeah. So let me stop sharing.
Well, that's fine, man. Yeah, no worries. No worries at all.
Yeah. So other companies. So I added Elastic again. It's just a small position. What they do is kind of like internal search. So if you think about how when you use Uber and you're a rider and it connects you to a driver, that's the type of internal search that they do. They power things like Tinder and Match.com. They can also do things like enable companies. So there's airports that use them to track their TSA lines and their security lines, and then forecast and help route people into the right lines and keep business and customers kind of flowing through the right lines.
Yeah.
So all kinds of things, but using search and data to basically power business decisions. So that's Elastic.
I could chat with you for like 47 hours straight. Wealth of info, man. You've done some research. I love that though.
Yeah.
I love that.
Couple more quick. I'm looking at Slack. So that's tickers work. Everybody knows what Slack is.
Yeah.
And then
I like the Silicon Valley. I'm sure you watch that show, right?
I actually don't.
Oh, put on your list, man. I know you work a
I
lot
don't.
and you crush things, but it's one of those things where you can knock out 20-minute episodes. It's like an hour veg every week or something. You can get a few episodes in. It's worth it. You'll like it. But at one point during the show, some guy goes, "What is Slack? Is it email? Is it text message? I don't know what it is." And you have Slack, Discord, and Telegram. And I think it's an interesting, really interesting distinction between some of those three. And I would love to see Slack buy out some of those.
Yeah, that'd be interesting. Yeah, Slack is a great way to think that you're being more productive by getting off email, but really being less productive because you have 9,000 different channels and distractions and emojis.
Bro, I got like Slack. 400 Slack channels. It's not
good.
Yeah, it's not good. But yeah, I think that's a great one. I'm glad you're bringing that one up. What's your thoughts on Upwork or Fiverr? I know there's not specifically in those realms, but
yeah, I've used both, just like personally.
Yeah,
but I haven't done any research really on either of those companies. Yeah, so I don't have a good opinion. What are you thinking about them?
Well, I think that there is going to be more of a massive distinction between in the next like 5 to 6 years when you're just hiring somebody. The amount of companies that are huge and medium size will remain the same, but the smaller companies are going to massively decrease because so many of the employees that we can use now for vast majority of things can be outsourced.
Yeah.
And one person, let's say you, could hold 9 different titles at 9 different companies, and work 10 hours a month for each company.
Right.
And work 90 hours and, have different various jobs and positions. I think the world is just going to go to that more with internet and just the way it is, the way we can communicate, getting jobs done through Upwork and Fiverr. Fiverr will be an interesting one just because it's so cheap, but they do make a lot of money. So it's kind of like a PayPal play almost, where PayPal doesn't specifically make tons of money, but they do a lot of like microtransactions and they end up loaning it. So Fiverr, man, you can get $1 to death as both a consumer and a seller. But Upwork, you have a little bit more of a finance fee. I do like them long term, and I'm excited to see 1 or 2 more earnings with them coming out. One company that doesn't necessarily fall in your scope as far as they do make items, but I think that the future is very bright for these items and their earnings are insane, is iRobot.
Yeah.
iRobot earnings over the last like 5 or 6 earnings in a row have just been dominating.
Yeah. I back when I had a bunch of positions, I owned iRobot, and I believe I don't know if they still are, they were a founder-led company as well. So the founder, the person who founded the company, was still in charge. Yeah. And I'm glad you brought it up because I went back and forth, and I think where I settled was like there was some threats from China, I think, and some like imitation products coming out the last I remember. And then I really haven't even looked and paid much attention since then. And that's one of the things about like only holding 10 companies and 11 or 12 companies is like you miss out on like so many great companies like iRobot.
Agreed. So is that kind of like your max, like 10 to 11, no more than that? That's kind of your cutoff.
So it's like I say all these things, right, and then I go back and like contradict myself. So that's part of it too, right? Is like I believe as an investor, like you have to be willing to be wrong, and you have to be willing to flex and like have some break your little rules, not be too prideful. So usually I want to keep it under 15 companies, and I want to be able to, and the reason for that is because I want to be able to really pay attention to what's going on at those companies. So that's kind of where I'm at. Like I like it 10 to 12, but I want to try to keep it under 15. That gives me some room to like wiggle and then not have to admit that I lied.
Yeah. No, I get that. I totally get that. And I can respect that. So maybe the last question, because this is a solid hour, man. I mean, it feels like 9 minutes, but yeah, that was amazing. Now I have so many notes. So many questions I could ask. Okay, how about this one? What's your biggest miss? Because I got like 9. So over the last like just year or 2 years, what's one you're like, oh man, this one, I was an idiot. Did not take that trade.
Yeah. So the really interesting thing about this question, right, is like generally the answer to that question will never be a company that you bought and that performed poorly.
Yeah.
Because the most you could ever lose is 100%.
Mm-hmm.
But the most you can win
out on
is what's the unlimited? What's the other word? The infinity. Sure. That's the word. That's the science word I was looking for. So yeah, it's, ask this question. A lot of people think it's going to be like, oh, what's the worst performing stock you did? And that's not how you ask the question, because you know what the answer is. I don't know. I'll tell you one, like, recently, and it just comes to mind because I don't know, and I don't want to waste your time. But Zoom. So I bought Zoom on IPO day. Yeah. And which is like, you should never do that. That's what they tell you. That's what all the experts tell you. Yeah. And I bought it for, I think it was $61 a share, something like that. They IPO'd on a Thursday or Friday. On Monday, I got super worried, and I let it get into my head that they were overvalued and it wasn't going to do well. And so
that's what everyone said on Twitter, Austin. They all said that, man.
I sold it at 59.
Brutal.
And then recently I bought back in at, I think, 101. So that's almost 100% miss right there in a matter of a few months. Yep. And then I bought a little bit more at I think it was like 85. So I'm sitting at like a $91 or $92 cost basis. So we'll just go with most recent. I'm sure I've had bigger misses. But for the sake of time, we'll go with that. And it's also a good lesson, because you gotta be willing to not price anchor and say, no, I sold it at 59. I'm going to wait till it gets back down there, because it may never get back down there.
It might not ever. Yeah. And I'm with you on, one of my favorite things is if I put out a trade and I get a lot of hate on it, I'm happy. Because, if I get a trade and everyone is all about it, they're like, man, that's the greatest trade of all time. I cancel that. Almost, not even kidding, almost immediately, especially if I put it on Twitter. If I put it on Twitter or just send it out into the world, like the Tesla trade, you probably heard about that one. I was called the Tesla bull for some reason. And, Tesla started bouncing, and so many people hated it. They're like, this is a terrible trade. You're an idiot. And I was like, well, I'm more of a fundamentals kind of, but technicals and leadership. Like, I'm with you on the leadership as well, and numerous other instances. But that was just one. The reason I'm saying it is because I like it when a lot of people disagree. And man, people are hating on Zoom and Beyond Me. They're like, these things are going to go to zero. And I'm like, I don't think so. I think we have higher to go on both, actually.
I'm right with you. So have you heard of stock twits? Yeah,
of course. Mm-hmm.
So I'll share my screen one more time with you real quick. Just kick me off if you got to go.
Dude, this is fine. No good. All good.
So stock twist real quick, and you just reminded me of it. Can you see my screen?
Yep, I got it perfectly.
Yeah. So, and it's kind of similar, right? Is if people hate your trade and you think it's a good idea. I also pay a little bit of attention to how many watchers. So just how known is the company I'm looking at. So Tesla, you're not gonna trick anybody by owning Tesla, right? It's like either people hate it or they love it, and that's one of the reasons why you could potentially do really well by owning shares, is it's so hated right now. And again, I'm not invested in Tesla, so I have no dog in that fight either way. Sure. But 224,000 watchers, right?
Wow.
So the companies I'm invested in, they've done really well.
No one's watching.
I still think they're relatively unknown, and so they're not as hyped as some of the haters think they are. So 3,000 people.
The haters.
The haters. 6,000 people.
Yeah. PD is a good one.
PagerDuty. I bet it's even less.
No one's talking. I'm all saying no one's talking about PagerDuty.
1,200 people. So Zoom probably has a lot, right?
Yeah, Zoom has well, it's not that many. I thought it'd be more.
So just another thing, and that's what's so awesome, man. About, like, I'm such a nerd about investing, but like you could just study all kinds of different stuff and take in all kinds of different, like, I like to scan social media and follow companies and their Twitter pages and follow their leaders. I heard about PagerDuty from Megan Eisenberg, who is the chief marketing officer at a company called TripActions. She used to be the chief marketing officer at Mongo Database. And before that, she was at DocuSign. But I follow her. She's super smart. I actually had a chance to interview her on a podcast that I do sometimes. And so I saw her tweet about PagerDuty before their IPO. And then, I read more about it, learned about it, and then invested in an IPO day. And it's done really well. So it's just really awesome, all the information we have access to now. Agreed.
Dude, thank you for your time, man. I really appreciate it. I know it's valuable, and it means a lot to me and a lot to the listeners and the followers and just everyone in the social media sphere. They have a lot to learn from you. So make sure to go check out Austin's Twitter and your website and your webpage. Sign up for that. Get some insights, get some information, learn from this guy, and go enrich some lives with Austin. So
yeah, really appreciate it, Jeremy, and thanks again for having me on. I'm going to keep following you and learning from you, and then I don't know, maybe hopefully we'll get to work together someday or do this again sometime.
Absolutely.
But yeah, I consider you a friend. I really appreciate your time.
My pleasure, man. Thank you so much.
All right. Thanks, Jeremy.
Yep. See you, buddy.
All right, see you.